Hey, welcome. I'm glad you're here because today we're going to talk about something that sounds very technical at first: politics, stock markets, and sudden market crashes. But behind the numbers, there's a story. And when we understand the story, we no longer feel afraid of headlines like "the market plunged 1,200 points" or "political chaos shakes investor confidence." Instead, we start to see the rhythm behind it, like a tide that pulls back only to rise higher later. So take a breath, settle in, and let's look at what really happened. Because if you only read the headlines, it would feel like chaos. But if you step back, you may notice something different, something that looks less like disaster and more like a setup for the next movement. Recently, Japan's Nikkei index dropped more than 1,200 points in a single session, an event dramatic enough to make global headlines. The reason? Two shocks arriving almost at the same time. First, a political shock inside Japan. Komeito, a longtime coalition partner of the ruling LDP, suddenly announced it was stepping away from the coalition. That alone was enough to spark concern. Political instability makes investors nervous. But then, like a second wave, came news from the United States, where former President Donald Trump, through a very simple post on social media, suggested that he would push for a massive 100% tariff on Chinese imports. Two surprises, different in nature but deeply connected in impact. One political, one geopolitical. Markets hate uncertainty, and this moment delivered plenty of it. So, what actually happened? Right after the Tokyo market closed, news broke. Komeito, the party that has long supported the ruling government in maintaining stability, announced its departure from the coalition. This triggered a chain reaction: yen buying, future selling, and a rush towards safety. Then, during the late-night U.S. hours, Trump's statement about adding heavy tariffs on China appeared. The timing was almost like a coordinated punch. Japan's market was already destabilized, and then the U.S. fed fresh fear into the atmosphere. Futures fell sharply, at one point dropping nearly 3,000 points from previous levels. And yet, within a day, the market stabilized slightly. Not because everything was suddenly fine, but because investors realized something important. In politics and in markets, not everything that is said is meant to become reality. Sometimes words are thrown out as signals, as negotiation tools. Take Trump's tariff comment, for instance. Yes, it caused an immediate shock, but just a day later, he softened his tone, saying, "Don't worry about China. Everything will be fine." This pattern is familiar. He creates tension, pushes for leverage, then walks back just enough to keep negotiation windows open. It's a tactic, not a final policy. Meanwhile, China responded with its own statement. It reminded the world of a small but powerful detail. China holds nearly 99% of the refining capacity for certain rare earth metals. These are not just elements on a periodic table. They're the backbone of modern technology. Precision magnets, defense equipment, electric vehicles all depend on these resources. So while tariffs are a powerful threat on paper, in reality, the U.S. cannot completely break away from China without hurting its own industrial base. Likewise, China cannot afford to have all its export channels disrupted without risking economic slowdown. Both sides know this, so confrontation becomes theater, a dramatic opening move before actual negotiation begins. Think of it as two players raising their voice, not because they are ready to fight, but because they want a stronger position at the table. With the APEC summit approaching, both nations have reasons to posture. They are throwing high balls, expecting to catch them later at a more favorable angle. So instead of seeing the US-China story as a disaster, see it as a negotiation dance. A loud one? Yes, but still a dance. But what about Japan's political situation? That's where things feel more unique and more sensitive. Komeito's sudden departure from the ruling coalition sparked an emotional reaction in the market because it hints at something deeper. Japan's political stability, long considered one of its strengths, now faces fragmentation. Without a stable majority, passing policies become slower, more complicated, more dependent on multiple parties coming together. Coalition talks become a puzzle, and the numbers don't lie. No single combination seems to guarantee a strong majority without compromise. Let me paint a clearer picture. The Liberal Democratic Party holds 196 seats. To pass key legislation confidently, they need at least 233. Komeito has 24. The Democratic Party has 27. Ishin has 35. No matter how you arrange these numbers, one thing becomes obvious. Any coalition will have to stretch, negotiate, and bend to accommodate partners. And partners, once needed, begin to ask for more say, more recognition, more policy concessions. That makes smooth governance harder. It's like trying to steer a ship with too many hands on the wheel. So, from a market perspective, the concern is not who leads the government. The deeper question is, can any leader maintain policy consistency long enough to support long-term economic growth? Investors aren't only watching who becomes prime minister. They are watching how long that prime minister can stay in power before the next shakeup. Markets like long-term visibility. They reward it with confidence. Remove that and you introduce volatility, not always in price, but definitely in sentiment. Let's connect the dots. On one side, we have US-China tensions, loud but likely negotiable. On the other side, we have Japan's internal politics, quieter but structurally unstable. Interestingly, analysts believe that the US-China situation will calm sooner than Japan's political uncertainty. That's unexpected, but makes sense. In international conflict, there are clear stakes. But in domestic political fragmentation, the road is less predictable. Filled with smaller parties, shifting alliances, and personal positioning. That's harder to map. Now, where does this leave Japanese stocks? For the short term, expect turbulence. Political headlines, coalition talks, and election timing will likely cause waves in the market. Fear will spike, then cool, then spike again. But here's the interesting part. Underneath the noise, the long-term trajectory still points upward. Nomura Securities even raised their target for the Nikkei, projecting 49,000 by the end of 2025 and 52,000 by the end of 2026. And looking even further, a long-term forecast suggests that by 2035, the Nikkei could reach 83,000. That may sound unreal now, but so did 40,000 decades ago. So if the long-term direction is up, what's the real challenge? It's the patience to withstand the instability between now and then. Politics may delay the trend, but not erase it. Economic cycles may create windows of fear, but windows of fear often become windows of opportunity for those who understand the pattern. Think about it. Historically, many long-term rallies began after moments of political uncertainty. Because uncertainty drives prices down, and lower prices create potential. Not instantly, not blindly, but gradually as stability returns. So, what should we take away from this moment? Understand the difference between noise and trend. Noise is loud, emotional, and immediate. Things like stocks crashed 1,200 points. Trend is quiet, structural, and usually invisible to those who only watch headlines. Trend lives in demographics, policy direction, technological adoption, corporate earnings, wage cycles, and inflation transitions. Japan has spent years stuck in a mindset of deflation, but every year data shows subtle shifts. Higher wages, stronger corporate earnings, and a younger generation of investors entering the market through apps and digital platforms. These are indicators of an economy slowly waking up. Politics may shake the surface, but deeper currents don't disappear. That's why even after heavy drops, smart investors don't panic. They watch, they observe, they wait for policy direction to reappear. And they position themselves not where the news is loudest, but where the fundamentals quietly build. So, let's bring this back to you, the viewer, watching this now. The next time a headline screams about market crashes, ask yourself, is this a storm or just wind before the sky clears? Is this panic permanent or a moment that will look small when seen from the future? Markets rise not because every day is stable, but because over time, economies find direction, societies adjust, companies adapt, and policies eventually align. And when that alignment comes, the market doesn't wait for everyone to feel comfortable. It moves early. It moves when uncertainty begins to settle, but before confidence becomes obvious. And that moment, for those who understand the story, is where opportunity lives. So let's watch the coming months, not with fear, but with clarity. Yes, Japan's politics will shake things. Yes, US-China tensions will flare again. But both of these, in their own way, are signals of negotiation, not final collapse. The world is rarely stable, but stability is not what creates movement. Friction does, and movement is what enables markets to climb. Thank you for being here with me today. If this helped you see the current situation not just as numbers, but as part of a larger market story, then stay curious, keep your perspective wide, and don't let noise distract you from the bigger trend. I'll see you in the next one.